It's a pleasure to welcome you all here to this year's annual investor conference. The attendees for this conference, this is our most global conference that we ever have had. We actually have attendees from 35 different countries. People have come from just about every corner of the world to be here. And this room is also a very powerful room. The individuals in this room are responsible for allocating approximately $10 trillion of assets. And while this is a larger conference than we've had in the past, particularly here in the Americas, this is about twice the size of the last annual general meeting that we had here in Miami. I think that you'll find that we've approached this conference with the same small company partners group care that we've always tried to put in to this event. You'll find that we've resisted the temptation to outsource the production of this conference to a third party. Every slide, every graphic, every message that you see on screen has been put together by our people, by our young professionals in particular. And we hope that their passion and hard work shines through over the next few days. You know, they call Florida, here in the U.S., the Sunshine State. And it's immediately apparent when you get off of the airplane why that's the case. In fact, in the 200 years that they have been keeping track of weather patterns, there's only one incident of snowfall in Florida's history. That happened in 1977. All right, but there's a lot more to Florida than just nice weather. This is a booming economy. This is one of the fastest growing states in the United States. There's a GDP here that's the equivalent to many meaningful sized countries. And there is a rich landscape of family-owned businesses and small and medium-sized enterprises here in Florida. In fact, if you look across our portfolio, we have meaningful representation across our private equity assets, our infrastructure assets, and across our real estate portfolio here in Florida. We employ approximately 4,500 people in the state. And those of you who know Florida know that this is a different kind of place. You know, during COVID, they had a slightly different tact than many other places. Okay? This was one of the fastest locations in the developed world to open up during COVID. After that first wave, they took a look around and they said, it's not so bad. And they got back to business. And they got back to business quick. And they have had wind at their back ever since. Florida's economy has grown 55% over the past 5 years. And over that period of time, since COVID, the economy here has surpassed the size of the economies of Mexico, Spain, and Indonesia, to the point where if this was a country, this would be the 14th largest economy in the world. Now, Miami specifically has an incredibly rich and diverse history and heritage and population. Miami is the only major U.S. city with a female founder. There's 150 different ethnicities in this city, 60 different languages that are spoken here. And one of the things that's interesting about this city is that most of the people who live here weren't born here. In fact, they weren't even born in America. This is a city of immigrants that bring with it a very rich set of perspectives, but also a very hardworking, make a better life for your children mindset that's driving a very dynamic business environment here. It's not just small and medium-sized companies that benefit from this entrepreneurial spirit, but since the last couple of years, there's been 134 major companies that have moved their headquarters here to Southern Florida. There's been $2.5 trillion of assets under management that's moved here. And the venture capital industry, which used to be very concentrated in Silicon Valley, has been dispersing. You find it today in San Diego, you find it in Salt Lake City, and you find it in Miami. There's been an 8 times increase in the amount of venture capital investment that's occurred here in Miami over the last number of years. It's also an attractive location for people. This is the #1 target destination for technology workers, particularly Gen X and Gen Z. It's a very diverse population. This is the #1 location in the U.S. for direct foreign investment. You even have some of the Wall Street titans that moved here to Florida during COVID, and they've made it very clear that they're not going back to New York. They're starting to call Miami Wall Street South, and there's predictions that over the next couple of decades, Miami will surpass New York as one of the financial centers of the world and for the U.S. Now, I don't know about that, but there's certainly business to be done here in Miami, and we've been hiring people here since the end of last year, and we anticipate opening an office here later this year. Now, if we look at this past year, this has been an unbelievably complex environment. Okay, we've had rates up, leverage levels down, and disruption is abundant. Okay, this is not a rising tide environment. This is not a wind at everyone's back environment. This is an environment where you see a tremendous amount of bifurcation between winners and losers. If you look at the public markets, S&P 500 last year was up 25% last year, a very robust performance. But if you dissect that performance, you had 20 companies that were riding this AI wave, okay, that were up 70% last year. The remaining companies, let's call that the S&P 480, were more mixed. Single-digit performance across that portfolio, and you had about 40% of that remaining population that was down, many of them down big. Again, this is not an environment that's a rising tide that's lifting all boats. This is an environment that is separating winners from losers. And I'm very proud that in our portfolio, by and large, we have a winning portfolio in this environment. Across our private equity portfolio, our average company had double-digit earnings growth last year and double-digit revenue growth. We also have an enviable and stable margin across our portfolio. We do believe that if we can consistently compound value and earnings at a double-digit rate, we can earn attractive returns regardless of the economic environment. We do acknowledge that we're not immune to challenges. We had 3 portfolio companies in particular that struggled during 2023, Charismatic, Hearthside, and Oxia. Struggled with topics like disruption. They struggled with labor challenges in some cases, and oftentimes leadership challenges. And there are lessons to be learned from these companies. But by and large, we have a portfolio that's robust and that's growing. We remained resilient and active in investing. This last year, we invested $13 billion into new opportunities. We had $12 billion in exits in a year where exits were tough to generate and liquidity was tough to obtain. There's also a bifurcation occurring within the private markets, and there's a big separation between organizations that can successfully raise capital in this environment, an environment where fundraising for the industry is down and down big. And we're grateful to you all for the trust that you've shown in us in giving us the ability to grow our assets under management by 8.5% in the last year. We do believe that this market environment is an environment that will be attractive from a returns perspective. Indeed, the returns within private markets have historically developed in a somewhat cyclical pattern. And the peaks of these cycles from a vintage year return perspective have generally occurred during or after periods of marked economic turbulence. If we go back in time to 2008, the last time we saw a liquidity crunch of this magnitude within the private markets, you saw a stark contrast in returns that occurred before that period of financial volatility and after that period of volatility. Now, one of the things that's interesting is, yes, median returns went up, but the difference between top quartile performance in particular went up. And you see the spread of performance between top quartile and bottom quartile increasing. Differentiation is key in an environment like this. And indeed, the people that are close to our organization, the people on the inside, and many of you all likely as clients and close partners of the firm, are aware of the differentiation that our firm indeed does have. We have a rigorous investment committee process where we encourage debate, challenges, fights, and asking questions. We have an intense focus on business building, rolling up our sleeves and embedding ourselves to solve problems within our portfolio. And we have a unique process that we go through to culturally integrate new employees into our company. Indeed, we are a differentiated firm. However, if you look at the company materials that we've had historically, we haven't always conveyed that differentiation that's so apparent when you walk through our front door externally. In fact, our company materials have sometimes felt a little corporate, sometimes felt a little one of many, and so we've gone through a process to align our identity that we have inside the firm with the identity that we convey externally. And indeed, we are an organization that is unique. We have a unique heritage, okay? We were founded in Switzerland. Our America's headquarters here is also built in the mountains in Colorado. We come from a different mindset than most of our Wall Street peers. We have a innovative culture. We've been a firm that has been a firm of firsts in many regards, and our organization is really built around solving complex client needs. In addition to that, we have an integrated platform that is built to solve problems for clients. Most of our peers are organized around individual funds and individual financial products, and we are an integrated platform built to deliver portfolio solutions. And this unique identity gives us the ability to build differently, okay? We build companies with the mindset of a founder, not the mindset of a financial organization. We build client solutions to meet the individual needs of our clients. 70% of the capital that we manage today are housed within portfolios that are custom-built, bespoke solutions built for clients. And we're building a special and unique environment to bring up talent. Indeed, we're an organization that is built differently to build differently. And hopefully you'll see that identity come through over the next few days. You'll note that we've chosen a color scheme that's more industrial than it is financial services. We also will use these brick stones to remind ourselves of that industrial identity. Hopefully that identity comes through loud and clear as you spend the next couple of days with us. So with that, I'll hand over to our chairman, who will go more into detail about this environment and how we're navigating it. Steffen, over to you.
Thank you, Dave, and good morning, everybody. Also from my side, welcome to Miami. We really appreciate the time you spend with us for these sessions the next few days. Thank you for that. As every year, I want to use that introduction to provide a bit of context for the next 2.5 days, but also answer some questions that many of you actually raised in the last 12 months. I'll do this grouped in 3 parts. One, I want to talk very briefly about an update on this role change between public-private markets we talked about for some time and how this is materializing in this new environment. Then second, and that's the main part, I want to talk about what's ahead of us. What are the game changes for the next 10 years and how do we actually drive investment success. And the third part is about scoping somewhat the asset class opportunities in private markets in the next 10 years. Now, as always, and most of you noticed from previous years, this is a room of super smart people. I don't want to bore you, so I'll do this relatively crispy. I might not touch on every number on the slides or the screens here, and just do this a little bit in a thought-provoking way, hopefully. So with that, I dive into that first part in this update and talk about this change of roles and where we stand today. You've seen this chart before. Most of you, I assume, we have previously talked about the fact that IPOs have lost relevance. And maybe as interesting, you see that the IPO companies tend not to be profitable anymore. And we shared some conviction previously that we see a role change happening, a structural change happening, where the IPO market used to provide growth capital to household names 40 years ago. But today, IPOs are an opportunistic exit instrument of private markets. VC growth capital is selectively buyouts. And even if you have buyouts exited in the IPO market with primary capital, that capital is used to repay private credit leverage. So in other words, there's not much of a financing function anymore of IPOs. And we see the opposite happening with private markets that started very opportunistic, as we know, but today they're essentially a very broad financing tool to steer the real economy. But there was always the question in the room, also I think in this round, is this really a structural change, or has this been maybe more of a cyclical phenomenon in this low rate environment? And so just as a quick update, in 23, we see that IPOs have come in just above 10% of the 21, the record levels. Compare this with private market transactions that have come down maybe 50%. And the few transactions we have seen IPOs were companies that were not profitable. So a little bit more of the same so far. We've taken a second perspective last year in particular, and we looked at the fundraising side of things. And we argued for a while that if we see the structural change, if indeed private markets become this new traditional asset class, you would expect market share taking by private markets away from the public markets. Okay? And we see this since 2016. You see here these gray bars. That is private market fundraising, which is outgrowing the public equity, global equity issuances. And last year, we talked a bit about the future. There was a question of, is that continuing? We said, we believe that the existing investor base will probably continue to allocate further. However, we believe there's actually, with this new paradigm of private markets, there's probably more demand by traditional investor classes, like wealth management, like VC, some insurance businesses. And so also here, a little bit as an update, if you look at 23, we have seen 3 times more private market fundraising than global equity issuance. So it's at a record spread level. And if you look at some of the headlines, you see a lot of new capital flowing in from specialist insurance businesses, from VC, from wealth management, and so forth. So with that, I think this role change that we have predicted so far, at least into 23, has materialized also. I'll connect back to that point just at the end of this introduction, because there might be some nuances that change a little bit. You might actually see a little bit of a renaissance of IPOs driven by private markets. So I'll come back to that later. If that was too brief and you have not heard us speaking about this topic before, there's a white paper on this, just should you have an interest. Now, with that, let me move to the main part of this introduction. This is about the question of what's driving the investment environment in this new environment, or as we call it, the Brave New World. Just to be clear, Brave New World, we don't take this little, so we don't expect like a dystopian society or economy. Not at all, actually. I think there will be a lot of great things ahead of us. But there might be, some elements ahead of us that might remind us, of Huxley's novel. So it's a bit of placeholder for some of the things that we might encounter the next 10, 15 years. So talking about the investment environment in the next 10 years, also with many of you in the last 12 months, it's clear there's 4 big topics or considerations that came up, typically. The first one is this really significant recalibration of the macroeconomy. The second one is the question around geopolitics and how that affects deglobalization potentially. The third one is about the labor markets and labor supply. And the fourth one about next generation of technology. So let me walk through them one by one and share at least our hypothesis, how we believe, this will impact private markets or Partners Group, what is a game changer and what might not be a game changer. So I start with the macroeconomy. What you see on this chart is that private market fundraising, that's the gray bars, but also returns, and Dave has shown this before, that's the top line, has been relatively independent of the environment. You see the rates and inflation at the low end, if you can see it, otherwise you have it in your materials. And if anything, I mean, the years that are not so good years on the return side, it's the pre-reset years, like 98, 99, 2005, 2006. 2021 will probably not be stellar years. I don't think they'll be bad, but I don't think they'll be terrific years. And why is that the case? Because valuations play just a more fundamental role. What you see here in the middle on the top side is if you assume a just double-digit growing business at 50% leverage, 5% capital cost, that's the old world, making 20% returns, and you take now the leverage down to 40, you double the cost of capital, or the debt capital, to 10%, you come down to about 17%. But if you now fix the exit multiple and you actually enter the business at one turn lower valuation, you're back at 20%. And this is exactly what's happening, actually even more than that. If you look at businesses like Velvet Care, our specialist hygiene product business, we just bought recently at less than 9 times, or Rosen, that's a high-tech inspection business in infrastructure. Think of it as combining robotics with software at 12 times. This is much, much more attractive than a while ago. I mean, a business like Rosen would have probably been sold at, I don't know, 15 times or so a short while ago. So in other words, as long as you're an active manager, you can grow these assets, this normalization, this new world is actually very positive in most cases. And certainly not a game changer for us, okay? Let me move with that to the question around geopolitics and deglobalization. What you first see here on this slide is measured by global trade, which is probably the best proxy. Deglobalization hasn't really happened so far. You see a softening with COVID in 2020. 23 might be a little bit soft with China and German exports being a little bit down, but there's no deglobalization so far. Now, in fairness, I mean, there's a lot of things happening, and we cannot predict how this is going to continue. Think of technology restrictions in some regions. There's some consumer nationalism in some regions, so companies like Apple, Huawei for some time, they of course experience some of that. But what I would tell you that outside the high-tech defense sector, outside maybe very large companies under scrutiny, that's probably something not so relevant for private market firms. So for private markets, I think the broader topic is the supply chains, where you see a rebalancing by companies from pure efficiency focus that we had maybe 10, 15 years ago to balancing better efficiency with diversification of supply chains and independence. And that has led to these developments of reglobalization, so going from one low labor cost place to another one, or what we call near-globalization is coming closer to your home base. Now, if you look at private markets, and maybe our portfolio in particular, you'll find that this is anywhere between neutral to actually positive in most cases. So a company like Form, that's our metal component engineering business, they had a bit, I would say, that ask from customers to diversify a little bit better. They're just moving to Vietnam with a new facility. Or you have Sterling, our pharma contract development business with a big hub in Europe and the US, and they benefit actually a lot from that business coming over from Asia. So again, here, globalization, geopolitics, it's a big thing, and of course, very carefully to look at sector by sector, but I would say by and large, for us, that's not a game changer for the next 10 years. So let me move to labor. It's a bit more complicated, okay? If you, broadly speaking, measure economic success by GDP, which is crude but probably still the best proxy, you see that in the last 2 decades, labor supply at the broad level has actually lost relevance. And you see the productivity, that's the gray bars, as opposed to bronze bars, has been much, much more relevant. Now, does this mean that there couldn't be labor issues in businesses? Not at all, actually, okay? And even if you look at the future where you anticipate, or people anticipate actually even more relevance of productivity versus labor, I think that masks a bit of fact that depending on the sector you talk about, there are clearly challenges. Dave mentioned that before. We talked about Axia. We have clearly one or the other situation in our physician practice management portfolio in healthcare, for instance, and we talk about that more specifically where we see some of these issues. But again here, if you take a step back and if you think at the broader portfolio level about this, you will actually see that much more often than not. This is something that is actually helping us or helping our companies because the companies position themselves exactly in that theme. So version 1 with digital services, or for instance, Omega, our belting business, they sit really in the middle of this huge automation theme in manufacturing where they help these businesses to address exactly these labor issues. So again, here, it's complicated, It has to be very carefully considered in every theme, in every company, but I would say overall, certainly not a game changer, certainly not something that is affecting us in a very negative way. So with that, I move to technology. And I don't start with numbers here, but with quotes. And if you look at these quotes, and I'm not going through them in detail here, you see there's incredible range of opinions. What will the role of technology be in the next 15 years? And you see some quotes like the FT quote here that are essentially dismissing the idea of relevance of technology or AI in particular. By the way, this quote reminds me a little bit of 98's quote of Paul Krugman. I'm sure most of you remember that quote. So Paul Krugman was asked about the impact and the growth of the internet. And his view was the internet will actually start to lose growth because there's not so much things that individuals have to share each other. Okay, so the growth will not be that spectacular. And he compared the economic impact of the internet with the fax machine's impact previously. And so with that, I would suggest we ignore these quotes and just go straight to what we believe or what we see as our hypothesis going forward as a game changer. And this is technology is a game changer for us in the next 10 to 15 years. This hypothesis is sitting on 4 pillars, okay? The first one is we believe that the next generation of technology will drive a next transformation of the economy, and I'll talk about that. This will come with a reconfiguration of winning business models that leads to a redistribution of profit pools. And now the big thing is a lot of that might happen in only 10 to 15 years, so in a relatively short amount of time. So I realize that's a pretty bold claim, and look, no one has the crystal ball, it's a hypothesis, but let me walk you at least a little bit through our thinking, some reasoning directionally, and also how this could actually unfold and what can we do about it, how can we try to maybe understand as good as possible what's ahead of us. And I want to start by addressing a myth or misperception: the only constant is change. I mean, I'm sure you see this like 10 times a day in statements by companies and so forth. Now the thing is, if not wrong, it's really very misleading because it suggests some form of linearity, visibility, forecastability of the future, which is simply not there. Because we have learned on and on and on, the only constant in development is acceleration of change. That's a huge difference because that doesn't come with that visibility, actually. Okay? And we have seen this in economic transformation. Industrialization took about 100 years to unfold, service business about 50 years. We had about 25 years in the first digital integration of the economy. I'll talk about that. If you look at any form of technology advancements, you see a very similar curve. So, for instance, all of us, adoption of PCs, 20 years, internet, 12 years, mobile phones, 6 years, and there's an assumption that in about 3 years or so, we'll all make regular use of some form of AI pilots in our day-to-day business. And even within technology, you can do the same in healthcare and other parts, you see a similar picture. So technology is not only about AI, but it's a big part of it. So if you look at AI, the development is very similar again. You know, to get to a, would say, basic kind of human level skill in terms of voice recognition, 20 years, image recognition, 10 years, coding, 6 years, and now language comprehension, as they call it. I mean, AI doesn't comprehend anything, but it's pretty good at mimicking that comprehension. You know, that took about 3 years, so it's pretty amazing, okay? So if you feel that hypothesis is not completely foolish, and there's some merits in that, what does it mean, and how do we go about it, and what's our way of maybe thinking about what is ahead of us in the next few years? I think a good way of looking into the future is, you know, try to maybe learn as much as possible from the past. If you look at the last 25 years, you know, what happened? I think a starting point for the last digital integration were 2 events unfolding. One was the connectivity integration, or you can call it democratization of the internet. And the second was computation power that was affordable. So suddenly, every company out there, even small companies, they had a server in the basement. They could run software. Every company had that. They connect with the other companies, customers, or supply chain. Then all of us, we adopted, you know, and we had suddenly these mobile phones, whatever, and we had connections. So in 25 years, we saw this digital integration of the economy, okay, lifted to a completely different level. But a fascinating thing, if you remind ourselves the last 25 years, was it's not just the technology that changed, you know, all the sectors have completely changed. So the indirect impact, the completely unforeseeable impact was absolutely massive. It came, though, in 3 waves. So in hindsight, there was a bit of structure to it with these 3 waves. I don't go into details here, that had a lot to do with technology advancement in certain stages. And I think we can learn from that by looking at what might be ahead of us, or at least try to create a bit of a hypothesis around this. So what are the 2 events that will maybe trigger a lot of that unfolding of that change of the economy? I think it's the access to AI or democratization of AI, very similar to the internet. And the second one is you get now computation power as a service, very, very affordable. The combined element is intelligence as a service. On your laptop, on your mobile phone, in your car, in your washing machine. And these systems, in contrast to the last 25 years, will not just give you support for activities, they will actually take over some of them. So there's more autonomy actually in that system. And some of these systems are pretty good in kind of self-regulating. So directionally, I don't want to overdo it here, but directionally, we go towards something like a self-learning autonomy of the economy in the next 10 to 15 years. And we believe there will be, again, 3 waves that have a lot to do with technology advancement. That's business process, performance, and innovation transformation. So I want to quickly talk about that. So business process transformation in the broadest sense is effectively co-pilots that you use for coding. You can use it for customer chat bots. You can use it for legal drafting of language, things like that. Some of that is already okay. Some of that is not that good, but it will surely come. When people talk today about AI, in 80% of the cases, they talk about business process transformation. We will have to do this. We'll talk about this in context of our portfolio company updates, but the reality is that's not yet the big deal. That gives you some productivity gains. It's a bit going from a typewriting machine to MS Word, maybe 2x productivity. Everybody will do it. You have to because of your margins, but it's not the big thing. The bigger thing is business performance transformation. Okay, this is becoming more interesting. This is where you replace entire tasks, entire processes, with new systems. Why don't you hear a lot about that today? The reason is very simple. Because there's not a lot of finished products. There's tremendous amount of activities, but not a lot of good products. But the ones that are out there are actually pretty breathtaking. If you look, for instance, at ECO, this company that produced this AI stethoscope that saves you $2,500 and 6-month waiting time for a heart condition assessment procedure. It gives you a prescription for a medical therapy without an involvement of a specialist. FDA approved. I think it's pretty amazing, actually. Look at the third one, healthcare as well. Sonia, it's a behavioral therapy chatbot, $12 a month, App Store. Okay, it amazed a lot of psychotherapists, especially when they heard that 3 MIT kids did it in 9 months. Okay, so these are the things. These are the things that we should just watch out for. This is business performance transformation, and this is what we have to watch out in our themes, in our business, in our ecosystems that we look for. Now, if you feel like this is a big deal, here's the biggest deal of all of them. That's my personal conviction, at least. Business innovation transformation. These new systems, AI is part of that, but it's not only AI, have become extremely helpful to leverage scientists in their work. I'm on the ATR Foundation Board, the Swiss Institute of Technology, and I can tell you, I hear every 2 weeks from a professor how much their work has changed. They talk about efficiencies of like 2x, 5x, 10. I heard 100x before. Now think of that. We have about 10 million scientists on this planet today, okay? 10 million. So 10 million people that do actually real stuff, research, right? We develop some stuff. And you take now an efficiency factor of 3, 4, 5 times. So suddenly in 3 years' time, you jump to 30, 40, 50 million scientists equivalent of productivity. That's the most amazing journey we've ever seen in innovation. There's nothing comparable in history. And that will come with a proliferation of innovation and results. Now again here, you don't hear much about that because there's a lot of things in the making that take a bit more time. But I want to give one example here, that's material science, where there's probably the highest, I would say, visibility of tangible results. There's a lot of tools, not only Google's DeepMind, there's many others that do these things, that test new materials, all kind of new materials that could be biologic, peptides, large proteins, it can be materials for batteries and so forth. And in the past 50,000 years, if we want to produce some ceramic, so think of solid-state batteries, for instance. You want to produce the ceramic, okay, that holds together the anode, the cathode, the separator. I mean, we cooked these things. It took a lot of time, and we tested them for like a year or 2 years. Today, a lot of that is happening in a digital way, and that comes with an amazing flood of opportunities. And you don't hear about that because in some instances, and healthcare is a good example, even if you have finished the drug discovery process, and my colleagues in healthcare will talk about that today actually, you still go through the in vitro testing, you go through the FDA process, so that takes a few years. Or in other words, what's happening is that it's a bit like a tsunami in a very metaphoric sense, you know. It's under the surface, it's starting, there's a massive amount of things happening, but it's a bit like these shock waves under the sea, under the surface. Okay, you don't see them unless you really go into these themes. But once, after 3, 4, 5 years, FDA process, all of that, they hit the market, they hit land, I think they can be really, really real. And they can actually change the economy in a very, very substantial way. So that is maybe just a little bit of a structure, directionally, how we maybe should think about, you know, what's ahead of us. But let's go back to what that change means and how could that unfold and why are we concerned about it and what should we do with it. So we talked about the fact that the last 25 years, we have seen a lot of indirect effects, not just the technology change, but the indirect effects. And, you know, there's a couple of quotes here, I mean, how people think and look back, you know, about that change. The problem is change is something very abstract, okay? But you can make change very visible, very easy. You can quantify it. That's profit pools. It's very simple. You can do this for every sector, every subsector. So I want to just look at one sector here, music industry. You see how these different waves have actually led to individual waves in the music industry, how money has been earned has changed 5 times. There was a time when we fancied ringtones, and ringtones made actually quite a lot of money. It didn't last for too long, actually, you know. And also interesting, it doesn't always go up. There's always this idea of stuff that we use on a daily basis that will always grow. No, it doesn't actually. It's much trickier, okay? And so it's not a surprise that we have seen a lot of reshuffling between winners and losers. And sure, you have seen that chart before. That's the top 10 firms in Standard & Poor's. One is in there still, that's Microsoft. Have you ever done this exercise at the sector level? Because the main argument here is that people say, well, of course, technology has won. That's why this has reshuffled. Well, look at sectors. Communication services, all 5 top firms have completely changed. Insurances, I'm sure there's some representatives here, you know, many of us feel insurances is a bit more resilient. I mean, it doesn't change so quickly. I mean, there's a bit of fintech, but that's a newer thing. Take Berkshire out because they don't really belong in here. Their non-insurance business is too big. They would not be in that index at all. The top 5 have completely changed. Materials, this is before the biggest ever transformation of materials. But the top 5 firms, they have already changed completely in the past years, okay? So the natural human reaction is, duck and cover, you know. This is bad, okay, you stay out, we don't want to have that disruption. The question is, can you duck and cover? Is that really a good recipe? So this is an overview of our mega themes, and we'll hear about that later on, next 2.5 days, private equity and real estate. So mega themes are these ecosystems where we have identified very attractive growth potential, earnings potential, so this is where effectively you want to invest your money, or your beneficiary's money. Now the red waves, they suggest that these themes are probably subject to quite strong economic transformation. So there's actually not so many themes that have moderate transformation. So in other words, trying to avoid, you know, economic transformation is probably a little bit illusion, you know, for most of us. So what's the segue here to the investment side of things? Let's look at the last 25 years, what investing meant to us in that old or last transformation. So you have this timeline, okay, 25 years. The color code suggests that economic transformation over time. 2 typical examples, 25 years ago, Odlo, a functional sports business that we bought, and VAT, a vacuum valves business back about 10 years ago. We transformed this business quite a bit, but if you look at the color code change in that holding period, it hasn't changed much, meaning that transformation was actually quite optional. It was actually not necessary. It just gave us a 4 times, or gave you a 4 times X instead of a 2.5 times X. And this is very different going forward, okay? This is the key thing here. If we believe there's some merits in that hypothesis of an acceleration and the next transformation of economy which happens faster than the past, here is kind of the picture you get on the investing side. Cloudflight, a digital service business we bought a year ago. We'll hold it maybe 5, 6 years. So when we sell that business in around 28, we have gone through nearly half of that economic transformation ahead of us. That means, think of that, right? Cloudflight at that point in time will have clients with different needs. Maybe some clients don't exist anymore, actually, they've changed. Different products, different needs. We operate differently with them. But also Cloudflight itself, our own supply chain, how we produce products, is probably set up in a very different way. So the only way you can address that is by being very clear in your mind, have a hypothesis of how that space develops, what's the winning business model, and to drive brutally towards that. So if you feel there's some merits in a hypothesis, I think you will easily conclude that in the next 10 to 15 years, this idea of buying defensiveness, buying resilience, something I've heard so many times the last 25 years, is probably a little bit an illusion. You have to build this, you have to have the agility, and this is where transformational investing comes in. Sitting on two pillars, identifying these ecosystems and creating a hypothesis where the winning business model will eventually move towards, and stay away if you have no hypothesis. And once you own the asset, be very active and pace with the board and management team the value creation projects towards that winning business model trajectory. Now, this is very abstract. I realize that you'll get dozens of examples by my colleagues in the next 2.5 days on transformation investing. Transformation investing is not optional anymore. It's mandatory in this new environment. Okay. I conclude this middle part, and I want to just finish off by giving some idea about where the investment opportunities will come from and how the markets will actually grow from here. What you see here on your left-hand side is private markets today, about $15 trillion US. Okay. In the middle, this is what we presented last year. Ask about the AUM development and where money is coming from and the breakdown between the different investor classes. We, describe this journey to $30 trillion over the new cycle. But there was always this question in the room, is the investment opportunity actually matching up the 30 trillion that might eventually actually come into the asset class? And I think our answer is very, very clearly yes. We're absolutely convinced about that. So just very quickly, directionally, I want to give you a little bit of a hint where we see this investment opportunity coming from. And I start with private equity. What you'll see is the growth will likely come down, also because we start off a higher base. It's higher than GDP growth, and that's for three reasons. On the one hand, you see small businesses, $1 to $2 billion, they stay in private markets. They will very rarely do an IPO, actually. That has changed. That's the role change. The businesses that grow, $3-4 billion, they will actually go and do an IPO. But very often, they will place 20-30% to repay leverage, for instance, stay another 3-4 years in the hand of private market investors. So this whole process to the IPO will be a slower one. And the third one is about a major opportunity that comes, especially with that transformation of the economy in mind, from divestitures of businesses. In this environment, many 20, 30, $40 billion companies, they cannot do 5 things at the same time. Will never work. And so private markets will very often take over these businesses. In a somewhat similar way, I think you'll see private infrastructure growing, probably the high rate, but off a lower base. And there's really 3 drivers. I don't go into details. Esther and team will talk about that very specifically tomorrow. Social infrastructure, but then specifically decarbonization and data services for this new economy. In real estate, this might be a bit unintuitive, because real estate undergoes clearly transformation and problems, and we'll talk about our problems also in our portfolios that we're working very hard on. But you will probably see quite a bit of activity in private markets, and that's for a simple reason that there's a whole lot of transformation in real estate ahead of us. That's coming from new ways of working, from living, new logistics. Mike Bryant and his team will talk about this more tomorrow also very specifically. Transformation in real estate usually does not happen in pension fund portfolios or in REITs. That's usually done through private markets that serve as a conduit. If you talk about credit, we assume that we also see a higher growth rate in credit. And that's really driven on the one hand by, that's the third box here, the private equity context or private markets, just growing. But there's 2 other areas that is taking market share from the banking side, particularly in Europe, in our opinion, and also from the public market side. So just the last word on public markets, it's a good segue. I've heard a lot of questions the last 12 months about the role of public markets. Are public markets going to disappear eventually because private markets now take over this role. And I want to just clarify this because maybe we were a little bit misleading in some of our passionate statements. This is not going to happen at all. What we probably see is a new era of a very synergetic coexistence between public and private markets. And the irony is actually a lot of that, or at least the IPO volume, the transactions in public markets, will be much driven by private markets. Think of private equity, small businesses, private. They go to 3, 4, 5 billion, 20, 30% is in the public market, payback leverage, stay there, further growth, and they stay there. So in other words, it's maybe not so much that the economy is financed through the IPOs, but at one stage these companies have a size where you just change the format of the holding, okay, and the investor base for some of these businesses. That's kind of synergies. And then you'll take a lot of these divestitures back into private markets. In a similar way, you see that in private infrastructure happening through these next generation platforms that we'll talk about. You build them clearly in private markets, okay? You need CapEx, you need acquisition finance over time. It doesn't work in public markets for most cases. But at a certain size, we see this with some of our data centers happening 2-3 years. They get to $10, $15, $20 billion. They have a nice yield. They have maybe coexistence of yield operations plus also development. At that point in time, they're probably great assets for insurance companies, for instance, so you put them back in some form of restructure. And real estate, as we talked about, real estate is the conduit, but then assets that are finalized assets that are held by institutions or by public markets through REITs. So with that, I hope I could give you a bit of context and a little bit of food for thought for the next few days. Thank you again for your time. I hope I can see as many of you as possible in the next 2.5 days for chats and some other discussions. And here we stop with the academic part, and now it gets more tangible with the actual assets, that we can develop on your behalf. And we start with private equity. Thank you so much.